So, the U.S. economy is growing at a 2% annualized rate, which is pretty insane, especially considering we're in the middle of a war with Iran. I'm Jack, and with me is Jillian. This growth is largely due to resilient consumer spending, a massive uptick in business investment, and higher exports.
That's crazy, right? I mean, who would have thought that the economy would be growing during a war?
Listen to this. As long as the economy continues to grow and companies are able to grow earnings, we can see higher stock prices even in the face of higher energy prices and inflation.
That's a pretty bold statement, but it makes sense given the current situation.
Consumer spending, which accounts for about 2/3 of the U.S. economy, grew at an annualized rate of 1.6% in the first quarter.
But what about the impact of inflation on consumer spending? That's a major concern for me.
When taking into account the 4.5% increase in prices during the quarter, real spending was actually down in the beginning of the year.
That's not good, especially for low-income families who are already struggling to make ends meet.
The economy got a massive boost by businesses, whose spending grew by a stunning 10.4% annualized rate in the first quarter.
That's a huge increase, but what's driving it? Is it just a temporary surge or a sustained trend?
This increase was solely driven by business investment in equipment and software, indicative of continued investments in AI.
Like we discussed last week, AI is really driving the economy right now.
I'm skeptical about how the government will handle this, especially with their history of mismanaging funds.
I share your concerns, but we need to give them the benefit of the doubt and see how they navigate this situation.
The increase in business investment is likely masking weaknesses in other areas of the economy.
That's a good point, and we need to be careful not to overlook those weaknesses.
For instance, real final sales to private domestic purchasers posted an annualized rate of 2.5% in the first quarter.
That's a positive sign, but we need to see how it plays out in the long term.
This is still an AI-driven economy, and the longer the conflict with Iran drags on, the greater the risk that higher energy prices continue to push inflation up and ultimately dampen growth.
The U.S. consumer is likely to be affected by higher oil prices, which could wipe out any boost from tax refunds.
We're seeing a similar trend to what we talked about in our deep dive on the economy a few episodes ago.
Yeah, it's like we're seeing a replay of the same issues that we've been discussing for months now.
The Federal Reserve is delaying any further rate cuts due to the ongoing conflict.
That's a big deal, and it could have major implications for the economy in the coming months.
The stock market has rebounded, but major indexes now at or near record highs.
But the Middle East conflict is now in its 9th week, and economists broadly agree that the longer it lasts, the more damage it will inflict on the U.S. economy.
As one expert said, the AI build-out will continue to support investment, but investment elsewhere will remain anemic.
That's a sobering assessment, and it highlights the challenges that the economy is facing right now.
The U.S. economy is headed into the Iran war on strong footing, but it's uncertain how long this growth will last.
So what do you think about the current state of the economy?
Drop a comment below and share this with a friend to keep the conversation going.